Well, CIT's got 24 hours to restructure its financing, and it's looking to Citigroup and Barclays for help. And we're joined now by analyst Brian Charles to help us break down CIT's option as tomorrow's deadline looms and approaches. Brian, first of all, though, is CIT safely out of bankruptcy? Is that off the table?
Well, I don't think it's off the table. I think they have a number of options at their disposal to try to avoid bankruptcy, but they need to launch this debt exchange. I believe they will launch a debt exchange as part of their recapitalization plan, right, and possibly some additional secured financing. But it depends on what the terms of that exchange are and how responsive the bond market is to, or the bondholders are to the exchange.
This deal, yeah.
That's right.
Brian, speaking of bondholders, the immediate concern for CIT, those bond issues that mature at the beginning of November, we're watching them this morning. They're under a little bit of pressure, trading at around 80 cents on the dollar. They represent, I think, about $800 million worth of debt. What is your expectation for how much they might pay those bondholders on the dollar?
I believe the company has the liquidity to pay off these maturities in 2009 and going into 2010. It's not a layup that will happen, but what I'm expecting the company to do is raise additional secured financing. I know that the $3 billion facility that the company put in place in July is substantially collateralized by almost all of the company's unencumbered assets, but the bondholder committee, I believe, is amenable to seeing that facility paid back if a restructuring plan is well received by the market and voted on by a majority of the bondholder committee. I believe that facility could be paid back. I believe that would release the collateral and free the company up to raise additional secured financing, providing them with additional collateral. Now, again, there are a number of moving parts in place, and I don't have much detail from the company at all, really, regarding what the structure of their plan will be. But I am optimistic that the company has the liquidity to pay, to pay off the maturities at least in 2009. But we'll see what the company announces.
Brian, I mean, why should the bondholders, though, why should they agree to any type of restructuring plan?
Well, the alternative, unfortunately, is bankruptcy. And I believe the trade-off here will be the possibility that the company or the bondholders need to analyze what the recovery value will be in a bankruptcy. And if they see that recovery value, and I have my own estimates, I think it'll be close to 70 cents on the dollar on an undiscounted basis. Depending on the discount rate you apply to that in bankruptcy, you might come up with a figure that bondholders think they will receive in bankruptcy. If they believe that they will, or if they see some terms from the company that give them a better upside in terms of current debt and potential equity value down the road as the economy improves, they could they would accept that offer.
Accept that deal.
Hey, Brian, it's Adam. Has the GM experience sort of taught us that bankruptcy is maybe not that big a deal, just a formality, a hurdle to get over until you're able to get on with business as usual? Is that one fair way to look at it? It's
one possible way to look at it. I guess I'm a little concerned in this industry, in financial services, especially in specialty finance. It's very rare for a company to emerge from bankruptcy, restructured, and it would be a profitable operator over the long term. Essentially, this business model does depend on receiving access to the unsecured debt markets, right, and so far that's proved a challenge in my experience with this industry.
That hasn't been coming yet. Okay, Brian, thank you so much for stopping by and talking about this. Brian Charles on CIT.